The roaring 20s have begun.
Absolutely. And I think the story for this decade is going to be how QE gets unwound, how we decide to take away what's become incrementally not such a positive force anymore and move to a more normal environment. There's going to be a fair amount of pain as that happens, but there could also be some winners.
Right. So when we talk about the idea of the winners, and I'll get to the pain in a moment, I guess, but I mean, the winners seem to be coming. I mean, while 740 of the CEOs that were questioned by the conference board, some of the concerns were recession. I mean, that seemed to be the number one concern. But what a great run we've had, and you can't deny the confidence that we're having, small business confidence, also consumer confidence, which is the best that we've seen since before 2000, builders confidence, the best from 1999 levels. So what's going on? People are feeling pretty great.
Well, I think you have to parse out U.S. confidence and what maybe felt abroad. I think the global economy was beginning to go into a slowdown/recession last year. And China's been dealing with that relatively well. The U.S. has avoided that almost completely. U.S. wage data, labor data, consumer behavior is clearly not showing any real kind of recession. With this trade deal, the potential of USMCA, and the Fed beginning to re-engineer the yield curve, there's beginning to be a sense that green shoots may be stronger from a real economic point of view. And the global economy may avoid that deeper recession that people had thought, and in fact may be kind of flat into the 0 to 1% area, but the U.S. may actually be 2 to 2.25, 2.5, which is clearly trend growth or slightly better.
Let's blow through some of your talking points, because you have so many great ideas and interesting things that we all want to hear about, and including watching the yield curve, right? So you're watching that, and how will you invest if?
Right. Well, the first thing to recognize is that when the Fed did what they did in response to the repo crisis, and we've talked about this before, they re-engineered the liquidity to the short end, but by doing that, they've kind of flipped the curve steeper. When they did that, the interesting clue was that the European and the Japanese curves have actually started to lift as well. That's kind of a global sign that risk on is a little bit favored here. Now, but that doesn't necessarily mean that it's, whole hog buy, sell volatility and go long equities, because we've gotten some of that return already. The question really is this quarter going to be a positive quarter until the Fed recognizes that things aren't so bad? And then what do they do?
You mentioned some credit assets that go along with all this, right?
So the question is, when yield curves steepen, you start to get concerns around credit unless growth overcomes that. And right now, growth isn't so strong that you think that credit risk can be completely taken off the table. The fear that we have is if treasuries start to yield more in that 4, 5 to 10-year area, they may actually become more attractive.
EMB, HYG,
EMB, HYG, exactly.
Right?
And the other part of this, and it's great that you mentioned EMB, is that the dollar, as the U.S. yield curve steepens up, the dollar doesn't look so weak. And it's hard to weaken the dollar as long as U.S. yields continue to attract those flows. So foreign credit could still be an issue, particularly if the U.S. yield curve backs up their duration-sensitive assets. HYG, not so much, but HYG does compete against Treasury yields. And there is an issue there that the spreads in HYG are relatively tight.
You were also watching TIPS and GLD, gold representation, right?
Yeah, so the point here is we want to get diversification for our clients. What we do as a firm, whether it's institutionally or for our retail clients, is we try to find ways to give them real diversification. The traditional 60-40 portfolio isn't really giving them real diversification because treasuries have a very low negative correlation compared to where they've been. Things like utilities have become very correlated to fixed income. If rates rise, that's a problem. So where are you going to get your diversification? We believed in managed correlation defense, so things like our JDIX fund that dramatically defends to the downside is very important. And then some of these assets that could do better in a cyclically supported environment, or maybe even, dare I say, an inflation-supported environment, could actually be positive. And when you look, gold and tips have dramatically underperformed. Now, inflation has been dead, but that may be the story of the 2000 teens. It may not be the roaring 20s story. And if that bet is actually cheap, wouldn't you think it makes sense to put a little bit, to trap a little bit for some of that potential correlation defense? So
the takeaway on your market advice for 2020 right now is what?
I think that it's very difficult to time the equity markets. And we've said all through 2019, as you remember, don't try to time the market. Just put in there solid hedges and solid diversification. We think diversification is hard to find, so funds like our JDIX. We think some of these assets like gold and tips that would be advantaged if, in fact, the Fed does what they say they're going to do, which is allow inflation to run hotter than it has. Guess what? Those assets do well. So instead of trying to play the 1999, the 2019 playbook, start looking towards the new playbook.